Good morning. This is Jason Balitzer and Jeff Pomerance of SulmeyerKupetz. Welcome to the life cycle of a business opportunity, part 2. There's a second in a 3-part series, which is not a series of specific recommendations, but rather a discussion about the general principles which tend to guide successful enterprises that we've seen. And it discusses basically the life cycle of a business from its inception to its ultimate fruition. Our experience has taught us that if you approach your and your client's next business opportunity with the framework that we've been discussing in mind, it will help you to ask the right questions at the right times so that that opportunity will have the best chance of success. Now, in January, Jeff and I discussed the importance of determining your company's philosophy before making the big formation decisions that we will discuss today. And we asked you to put on your thinking cap and recognize that by answering certain questions now, such as how much control am I willing to cede? Do I want this to be a neighborhood establishment or a global enterprise? Do I want to share responsibility? How will I cash out? Those sorts of questions. You will be in the best position to plot out your journey. And today, we begin talking about that journey. We will discuss the considerations you need to make when choosing your entity structure, making financing decisions, making operational determinations, establishing management and control, and finally, briefly, determining your ultimate exit strategy, which itself will be the subject of a later webinar. And now, Jeff will introduce himself.
Good morning. My background is contained in the deck that accompanies our presentation. But briefly, I have experience as an accountant, attorney specializing in startups and mergers and acquisitions. I have experience as an entrepreneur, starting businesses, and prior to joining SulmeyerKupetz, was involved in private equity as the CEO and general counsel of an incubator which focused on early stage investment opportunities. This is an area that I really enjoy and look forward to discussing with you to help you make the best decisions for you. Jason.
My name is Jason Balitzer. I work with Jeff, and we both do a lot of corporate work, although I also find myself in the courtroom just as often as I find myself in a conference room. A principal focus of my practice is representing corporate debtors and bankruptcy trustees in transactions, but also I enjoy working and regularly work with non-bankruptcy clients and startups and just running the gamut. It's always a pleasure.
The next slide that we put up is kind of an overview that we wanted to use to address the life cycle itself. As you'll see, we have the pre-formation, formation, growth, development, maturation, and evolution and exit strategies. I think one of the things that we want to initially impart is appreciation of the process. Too often we want things to be done immediately, and while we'd like that to occur, it really is more of a process, not an event. We are going to focus today more so on the second and third, the formation, growth, development, and maturation. But again, one of the things to bear in mind in this process is, an entrepreneur may have some amazing ideas. Well, I refer to them as kind of the Pied Piper, who can see an opportunity in a technology of various goods and services that are needed, and not only see them, but see a way to monetize or make them a profitable opportunity. Typically, this person or group has a passion for creation and may be a tremendous firebrand in getting this opportunity going, but may not have the skill set to be a CEO of a company that's gone from initial formation to operations. So one of the things to bear in mind in this is by having this appreciation of the process, it helps you understand where you are along that lines to measure where you are and what you may need to go to have and to do to get to the next level. One other thing I want to add that I think is important, our qualifications, I think are unique in this regard. Both Jason and I have experience, Jason being very, very modest. He's got an unbelievable skill set in both transactional work and understanding what happens when you actually leave the transaction and go into a courtroom. But one of the things that we have that I think will be helpful, and we'll try and share that with you, is that we understand the entire process, not just one of those circles, but all four. And again, I've lived through personally some of these, not just as a lawyer or accountant, but also as an entrepreneur and an investor. So the hope today is that not only we'll be able to give you some insights, but to share some specific ideas and thoughts that we have from our experience. Jason.
So today, we aim to do three things. First, we aim to entertain. We certainly want to entertain, and our goal in the next 50 minutes is to share with you insights and thoughts that will make you think about what you want to do moving forward, and know that you've given sufficient thought to what you seek to accomplish. And as with all our presentations, perhaps the most interesting lessons are found in sharing with you some specific war stories from our experience. And we also aim to educate. At the end of our presentation, it is our hope that you will have a greater sense of approaches to use in successfully developing a business opportunity. And you should know and what you should be thinking about as you are moving forward with your business opportunity. And we will be there to help. And lastly, we want to empower. Although this statement is a bit trite, the fact is knowledge is power, and we hope that what we share with you today will get you to think about how you and your opportunity can be a success. You have a map and a vehicle to get there. Now it is time to see it to your goal.
Now, one of the things that's important perhaps to know is what you're not going to hear today. We're going to talk about structuring ideas and thoughts and recommendations, but there is no specific recommendation because really there's no one-size-fits-all. There's no simple form. Too often I'm called and someone says, can you just give me this form or that form? And the answer is I can certainly give you a form, but that doesn't mean it's going to work for you. Each situation requires focus on specifics. As we hope to impart to you today, there are many nuances that you need to consider so that you can create something that's ideal to your opportunity. The next thing you're not going to hear is you're not going to hear a recommendation of industry or service. They announced this past Sunday, I believe, I got the email that Sports Chalet is closing. We know that Sports Authority is in Chapter 11 right now. So it would be easy to say stay out of sports apparel, or in the case of many of the bankruptcy filings lately, stay out of energy. But we're not going to say that, and the reason is that, believe it or not, some people actually make money investing in opportunities that everyone else runs away from. So we're not going to downplay any specific sector. We're not going to downplay any specific service. Really, our goal is designed to educate on what may work for you and your opportunity. Lastly, and again, this may sound a little bit, it's consistent with what we said in our first webinar, there's no secret to success. We found over the years and through experience that there's a correlation between hard work, planning, and studying, seeking advice from experts, challenging your assumptions, executing on your game plan, and last but not least, luck. On the other hand, I do believe there is a secret to failure. As Coach Wooden said, I believe, failure to prepare is preparation to fail.
So, although every business opportunity is unique, the fact is there are commonalities which tend to be shared among all enterprises, large or small, young or old. These are everywhere. These 5 areas that we're going to talk about today almost universally need to be addressed among businesses.
Jason, one of the things that I think it's important to note in this slide entitled Achieving Harmony and Balance Pre-Organization, is this really, in a general sense, is something that everyone either consciously or subconsciously does as they're forming a business and developing their opportunity. There can be more, there can be subsets of these. We decided to address these 5, both because we want this to be under 3 hours, but more importantly because I think that the good sense of these, if you could come away from our presentation with a sensitivity to these 5 areas, I think you're going to be in great shape in terms of building out your opportunity. One of the things that we'll now touch on briefly, and Jason and I will delve into, because I think it's important to address this, is the possible business entity structures. So often when talking to people, we either that something like this is taken for granted and really not known, or we see people that want to go into nuances of specific ones, and we thought maybe it's a good point to take a step back and just give you a general lay of the land. It's the 6 different possible business entity structures, and there can be more, but those are sole proprietorship, general partnership, limited partnership, corporation in 2 various formats from tax purposes, subchapter C, which is a corporation that we'll talk about that is taxed at the corporate level and then taxed on distributions generally. Corporation subchapter S, which is what we will call a pass-through corporate entity. And last but not least, the limited liability company. Jason, why don't you give us a little bit of an overview of all 6 of these, just so we're all on the same page as to what we're talking about.
Absolutely. Well, sole proprietorship is the simplest type of structure to establish. It is comprised of an individual owner who pays personal income tax on profits from his or her business. General partnership is an association of 2 or more people formed with the purpose of running a business for profit. All partners equally share in the profit and the risk, and taxes are passed through to the partners. A limited partnership is also an association of 2 or more people, but at least one of whom is a limited partner who has less control over the partnership operations, but there's also less risk. A C Corp is what most people think of when they hear the word corporation. It's a business incorporated under the laws of its state and taxed separately from its shareholders. It is also, we noticed, often a desirable structure if the ultimate objective is to go public. An S Corp is a special type of corporation which avoids double taxation that the C Corp is so famous for, because unlike a C Corp, it does not pay its own income tax on profits. It is not allowed, though, in all states and subject to certain rules and restrictions not imposed on C Corps. Lastly, an LLC is a business structure which combines the limited liability of a corporation with the pass-through taxation of a partnership or sole proprietorship.
Great, Jason. Now, the next thing I think that we want to, again, just touch on so everyone gets a feel for the nuances, the specifics of each of these entities, is issues to consider in comparing the different entity structures. Jason, why don't you run through some of these concepts and explain how each entity or the entities have differences so that we can, get a sense of how this may play into structuring your business.
Well, limited liability is the first that comes to mind because often people establish their business to specifically limit their liability. And C Corps, S Corps, and limited liability companies, and with respect to limited partnerships, all offer limited liability if the corporate and organizational formalities are followed. Sole proprietorships and general partnerships, on the other hand, do not offer limited liability, and the assets of the owners can be reached to pay the debts of the business. Also, general partners of limited partnerships can have personal liability for the actions of other partners in the partnership itself.
Let me just jump in here, and that often we see someone starting their business, they have very limited funds, and they feel, I really don't want to spend the money to either incorporate or to form an LLC. I'll just get up and running, and then once I do, I can evaluate that. It's certainly understandable, but I urge people at the earliest inception to look for an entity that provides limited liability for a host of reasons which we'll get into later, not the least of which is investors hate to put money into something and find out that they might be personally exposed. Anyways, Jason, why don't you continue with pass-through taxation?
Well, sole proprietorships and general partnerships, limited partnerships, limited liability companies, and S Corps all have pass-through taxation. And out of the 6 we mentioned, C Corps are the only ones that do not. C Corps are taxed on profits at the corporate level, and then those profits are then again taxed when the C Corp distributes them to its shareholders, and this is commonly referred to as double taxation.
Jason, let me just add on that one. Most of the time we look at the concept of pass-through taxation as a real benefit. In other words, if in the early years there's a lot of expenses, that's a good thing to have, because that can potentially flow through to your personal income tax return. The the specifics of tax we'll leave to another day, but just to let everyone know that there are instances where it actually makes sense not to have a pass-through entity and to have the, if we will, a C corporation. I'll give you a case in point. When a lot of the income that you derive, if it's a cash basis, you want to reinvest in the company, but the reinvestment isn't in itself an expense. In that context, you may have income that flows through, yet the cash that you'll need to pay that income being reinvested in building the business isn't available. And one of the worst things that a professional advisor can do is to allow a situation, again, these happen, but certainly to work to make sure they don't, is to have a situation in which someone is hit with taxable income without the cash to pay that tax. Anyways, getting back to it, Jason, perhaps you can now touch on continuous life.
Absolutely. That simply refers to whether or not the business will keep going when the owner dies or withdraws. Obviously, in the case of a sole proprietorship, it ends when the individual ceases operating the business. C corps and S corps, on the other hand, both have continuous life, meaning that the business will go on. General partnerships, limited partnerships, and LLCs, they may have limited lives or end upon the death or withdrawal of one of the owners. This is frankly often addressed in the partnership or operating agreement of the business. Next would be management and authority to control affairs. Sole proprietorship inherently offers the highest level of management and authority. The individual proprietor is the only owner of the company. General partners manage and control the affairs of general partnerships and limited partnerships. To the extent there is only one general partner in a limited partnership, that one general partner will be able to exercise control more freely than under a general partnership, as he or she will not be bound to consult with limited partners on many decisions. C corps and S corps are managed by officers who are selected by a board of directors, who are in turn selected by shareholders. And LLCs are managed by managers who are selected by the LLC's members. And a manager of an LLC may or may not be a member. It just depends on what is authorized under the LLC's operating agreement. As far as the number of persons needed to form, a sole proprietorship is comprised of one person, always is. General partnership and limited partnership will always have to have at least two people. Now, C corps, S corps, and LLCs can all be formed by one person, and C corps and LLCs have no maximum number of shareholders and members. An S corp, on the other hand, can't have more than 100 shareholders.
There's one other thing to note, Jason, that for an S corp, if the investor or the shareholder is a corporation, it cannot be a subchapter S.
Mm-hmm.
The only type of investors in a subchapter S are individuals and qualified S trusts. So if your investor is a corporate investor and you want the kind of advantages you might get in an S corp, typically they turn to an LLC.
And they have to be a U.S. citizen or permanent resident.
That's correct.
Obviously, one of the things that comes to mind is money. How much will I have to pay to form this particular business structure? And sole proprietorships and general partnerships are the easiest structures to form because you don't have to pay anything. Limited partnerships are also they're a little more complicated than general partnerships because they actually require a detailed partnership agreement. That actually establishes the distinction between the limited and the general partners. But they, too, are still easier to establish in corporations or LLCs. No fees for formation. Now, C corps, S corps, and LLCs all require filing the Articles of Incorporation or Statement of Organization with the Secretary of State, and they also require the payment of formation fees and generally ongoing annual fees. So that is something that people are going to consider. Then transferability issues. This is one of those things you have to think of now so you don't run into problems with it later. How do you transfer ownership? Well, C corp shares are generally freely transferable. This is one of the reasons the structure is popular among startups that are intended to one day go public. S corp shares, they are more freely transferable than LLCs or partnership interests generally, but as we just discussed a moment ago, they are subject to certain restrictions that are not placed upon C corp shares. The individual capacity of the owner, the nationality of the owner, they also can't be transferred if the transfer would result in increasing the ownership of the S Corp to above 100 shareholders. So if you have 100 shareholders, that's it. They can't be transferred, at least in such a way that would increase it to 101. Now, LLCs, partnerships, and sole proprietorships, they're not really generally freely transferable, though the relevant operating and or partnership agreements may have language that governs the transfer of ownership interests.
One of the things, to finish this slide out, we talked about general advantages and disadvantages. And hopefully you can get a sense from what Jason has said that when you're talking about things like limited liability, well, you prefer a corporate entity or an LLC. When you talk about pass-through, and if that's a benefit to you, you talk about an S-Corp or a partnership or an LLC. We're going to get into more of these things as we go through. Whether it's an advantage or disadvantage really depends on your point of view. In the 80s and early 90s, we saw, for instance, in real estate development deals, we saw limited partnerships. That was prior to the advent of the LLC. With the advantage of an LLC over a limited partnership in that instance is you only have to have one entity as opposed to two or more. Generally, the general partner in a limited partnership would be a corporate entity. So you had two entities. So you could kind of cut back on some of those. But again, one of the things to really think about, and there's no answer because it's unique to you, is what are the advantages and disadvantages. And those will be governed, as we're going to discuss further, by some of these other considerations: financing, management, operations, and even your potential exit strategy. So it's just important to note that all of these things need to at least be thought of as you're building the vehicle for your success. One of the things now we're going to talk about and jump into is the financing and capitalization considerations. And while all of these 5 boxes are important, in many instances this tends to be the most important. Every company to succeed has to have a financial source, the necessary and requisite funding to build the opportunity from a vision to success to a operationally successful enterprise. So one of the first things to think about is, what do you need today, and what will you need for your next step, both short-term and then, of course, long-term. And again, that's something that will vary and change even within a business as you continue to evolve along this life cycle. But it's the initial step, the first thing to think about is, what are your financial needs? Now, one of the things to think about is, okay, I have financial needs. Where am I going to go to have those needs met? And that's the concept of potential and actual investors. And when you talk about this, we want to kind of lay out some ideas and thoughts for you to consider that aren't necessarily apparent when you're going through this process. First, there are corporate structural issues. I will tell you right now that in doing this since 1987 as an attorney and onward, that I have never seen any sophisticated investor invest in a non-limited liability context. In other words, the fact that you have a general partnership might make sense if you're 2 corporate entities coming together. We actually refer to those more as joint ventures. But corporate structural issues are an absolute primary consideration. People want to know that when they invest and put money into an enterprise, regardless of the form of the investment, that investment is protected. So again, in terms of advantages and disadvantages, the corporate structural issues may well determine your ability to get potential and actual investors. The next thing to think about is security law issues. Now, I guess quickly, and I don't want to focus too heavily on securities law, but other than to note, what is a security? A security under the 33 Act, 15 U.S.C.S. 77B, the term security is any note, stock, treasury stock, security future, secured-based swap, evidence of indebtedness, interest or participation in any profit-sharing agreement, and typically investment contract, transferable share, and we tend to think of this as participation in the upside and downside, if you will, of a business. Now, why is that important? Because certain of the vehicles that we may talk about in terms of financing, which we'll get to a little bit very soon, debt financing is not a security. When you have a security, you have to do one of two things. You either have to file a full-blown offering statement, or you need to seek an exemption for small offering exemptions, typically under Reg D. So it's important to note that when you are offering equity in that context, that you need to be sensitive to securities law. And one of the things that I hear quite often is, well, I'm not a public company, I don't have to worry about that. I don't have all the requirements that are imposed upon a public company. And that is true in terms of many reporting issues. But there's always a concept of 10b-5, which is that you need to disclose it's a meaningful kind of disclosure requirement, that you can't fail to disclose a material term, and you can't disclose a material misleading term that someone would look at and say, gee, had I known that, I wouldn't have invested. That can subject you to liability. And so you want to be careful to those kind of issues. And again, as we'll talk about further, not all of the vehicles to raise money are have security law issues to them. One of the most important things that we want to share with you is the concept not all money tastes or costs the same. I know that sounds kind of funny, but it really is true. I've been involved in startup and early stage companies where the investors were people that not only did you want investing, but you wanted on your board, you wanted them anywhere near your business. They brought value either through their knowledge, their understanding of the industry, their skills, their relationships. It is a very, very different set of circumstances when you have a sophisticated investor that is a successful investor and sees the value in your opportunity. It can propel you quickly into the successful realm of this life cycle. So too, when you have private equity, you need to understand who they are and what their goals and ambitions are. Typically, VCs that I've dealt with over the years are a 3 to 5 year window. They want their money back in that time. By that time, they want a return on investment. It's a buy and a significant return on investment, 20 to 30%, let's say. And what they typically move you to is to make decisions that you may not want to make if you're a buy and build opportunity. Again, one of the other things that you want to be sensitive to in terms of your investors are these people that are going to help you. Certainly they need to be given information, but when their approach is to get information that requires you to spend significant amounts of time preparing information for them, is that the best use of your team for purposes of building your business? Lastly, and certainly not least, is timing and costs. It is within the process, fundraising and financing is a specific timing category. You want to build the financing opportunity so that you show what they call a positive run. In other words, if you're going to do multiple financings, show at each stage along those that you're building value. So the timing and it ties into value as well. The timing is crucial. When you need that money, how you need that money, from whom you need that money, and what's the cost. And the cost, again, is both what I call hard costs and opportunity costs. I will tell clients that want to raise, for instance, less than $100,000, it might be easier to do it in the context of debt as opposed to equity because of the legal and other concerns, accounting concerns that you want to address so that your offering, be it a debt or equity play, maximizes the benefit that you're trying to achieve. Now, we talked about it a little bit, but let me kind of delve in equity versus debt. Too often we just throw those concepts out. What are we talking about? First off, in its truest sense, equity is the right to participate in the future, if you will, upside, and the right to achieve benefit in the present downside to the extent it's a pass-through. but it's a profit share, if you will. The advantage is, there are many, but we'll give a few. You do not need to generally pay it back immediately. And it's certainly attractive to people that invest in your enterprise at an early stage. Again, the concept of risk and return, the return is potentially limitless. Ask those people. I was reminded in 1980, someone had showed me, early 80s, the Dell offering, and what that would have been worth if you invested $1 million in 1981, what that would have been worth in 1990. And we can do that with Google, Facebook, on and on. The equity is the driving force behind financial, meeting your financial needs for companies that are looking forward to a bright future and can articulate that to their investors. The disadvantages of equity is that, number one, it's security. There's liability, like anything. This is not, the money that's in that company isn't your money, it's the investors. You have to handle that consistent with all the fiduciary and other legal and obligations that go along with that. And a lot of times we'll talk about, you have issues of control. People that put more money into an enterprise feel that they should have a greater say in its vision and moving forward strategy. Then there's the debt component. Debt typically, or for in the simplest form, is I promise to pay you at a certain interest rate at a certain time frame with the payment set forth, generally in if there's a written document, but certainly it's the IOU. It generally does not have securities liability, and it generally is a great way to have money, raise money without giving up control. Although, as we see over the years, debt sometimes also requires certain covenants that can kind of hamper that. A disadvantage to, one other advantage to debt is those payments of interest are generally deductible to the entity themselves. The disadvantage of debt is debt generally comes before equity, and means that you have to pay back your debt investors before your equity investors. And I'll tell you why that is a nuance that when we don't often think about, touching on this concept of pass-through. A lot of times we'll see an LLC, and let's say the LLC is it could be an S corporation, but in this case an LLC, and it has a profit at the end of its year. So it has income that it is allocated to its equity owners based on their percentage interest or ownership in the entity. And so in that context, conceivably, there could be taxable income from the entity that flows through to the individual for their individual tax purposes. Yet you could have debt on an LLC, and the debt may typically have covenants that prohibit you from distributing cash to the equity until the debt holders are paid. So now you run, as I mentioned earlier, you run that problem where you have a situation where the investors are deemed to have income for tax purposes, yet the LLC entity is not permitted to distribute the cash. So you have to be sensitive to these issues and work through these issues. One last thing, an equity versus debt, is, as with anything that seems to occur with bright minds, there's all kinds of flavors in between the traditional debt and traditional equity. We've seen I've seen convertible debt. We've seen debt with warrants and other features that allow you to have equity participation. I've seen, in less instances, I've seen preferred equity that allows you a warrant as well to get either debt or more equity. So there's all kinds of nuances in between, but it's important to understand what those two major components are. I want to touch briefly, before we finish with equity on financing, on two considerations that I think are important. First off, follow-on financing. Follow-on financing is interesting. There's an article today in the LA Times that the first quarter marked the slowest period for investment in LA startups in 2 years. It's just over $400 million going into about 50 companies. And the question is why? Perhaps the startups are growing more slowly, conserving more cash. The article touched on that, and thereby reducing the need for new capital in uncertain economic times. But it's interesting to note we see less M&A activity. In other words, the number of venture-backed companies being acquired is decreased over the last year. We see certainly a downturn or no activity in the IPO market. And so what we're seeing is less of a sense of both the validation of value and exit opportunities. And the VCs and private equity appear to have adjusted. They're saving their cash to prop up existing investments. And I've seen, for instance, in the trades, a lot of the private equity are talking about the platform strategy. The platform strategy is where an investor, whether a private equity fund or investor, for instance, a lot of family office investing seems to be growing over the years, will acquire a platform company and then proceed to make strategic acquisitions within that same industry or in related products and services. And the idea is it enhances the value of the platform. The initial acquisition of the platform company will also serve as the first building block upon which the investor will do add-on synergistic business acquisitions and thereby absorb IP and technology through M&A and make other investments so the business grows as a kind of a consolidated basis. I think it's important to note this only because going back to not all money tastes or costs the same, if you are fortunate to have a financing need met by an investor that has multiple investments that may actually benefit your business, it's not only an investment meeting your financing needs, it may actually be assisting you in your marketing, distribution, and business development. So what we want to do is we always want to try and look for setting up a corporate structure, entity strategy that maximizes your opportunity for follow-on financing. Lastly is, given this market and given what I just said and given what's happened in the startup in the past year, you need to be creative. You need to think of alternatives to financing. And what might those be? Because again, you may not have the VC interest that might have occurred 1, 2, 3, 4 years, 3 years ago. So certainly a lot of the early stage companies I work with look for small business loans, family investment. They also look at hard money loans, factoring as an example. These are expensive in terms of cash. But again, if you believe and you can articulate that the value of your business lies in its equity, then this might make a lot of sense. We see, for instance, we've worked on transactions where we've tried to get forward deposits or prepays and services, which is a great way to get cash without giving up equity. And of course, while we're talking about financing needs and focused on the sources, one of the areas that we haven't touched on today, but certainly one needs to think about the uses, and that is watch cutting cash and managing your costs as best as you can.
Aside from raising money, one of the primary things that you need to consider is who's actually going to be managing the team. Obviously, it's not just as simple. It's not just as simple as finding a need and filling it. You actually have to appreciate the benefits that you can get out of choosing the right people and choosing them early. And the first step in that is really understanding each of the roles of management. Now, the founder and CEO is the easiest one to identify. That's the leader, the one you'd call the Pied Piper, the one with the vision. Now, this individual is the face of the company. This is Mark Zuckerberg to Facebook. This is
Bezos to Amazon.
Exactly. Then you have the CFO and the treasurer. This individual is in charge of two things. They set up the financial apparatus for the company, but they also oversee its ongoing financial health. And this is basically saying that he or she not only ensures the lifeblood of the company, but also measures its pulse. Chief Operating Officer is the actual person who runs the company on a day-to-day level. And then, as important as financing is, At the end of the day, the company needs to learn how to walk on its own. Sales, generally a vice president of sales, there's an individual that's actually responsible for selling goods or services and otherwise making the company self-sufficient, making it so it's not so dependent off its initial financial investments. That being said, that's management. Those are the people that run the company. That is not necessarily control of the company. What you have to really do is you have to understand and clarify what control means. You hear the phrase controlling shareholder or controlling interest. And when we're talking about control, we aren't talking about running the company day to day. But ownership and control are not always the same thing. I mean, sure, they may be in a sole proprietorship, but in a corporation, ownership are the shareholders, and they're represented by the board of directors. Control are the officers handling things day to day, who answer to the board of directors, who, by extension, answer to the shareholders.
Jason, one of the things I want to kind of interject here is a couple things. First, of the roles of management. Early stage companies, you may be wearing multiple hats. You need to do whatever you can to get your company going. The hope is as the company builds out that you're able to fill these functions. It's very, very helpful to have different people doing these jobs for the reason that there's a wonderful dynamic that occurs when a CFO and COO and the salespeople have to work together, and it can be very helpful in building the business. Along those lines, in terms of clarification as to control, I think it's very important to note financiers tend to like the word control. And so one of the things that we've done and we continue to do when we work with early stage and startup entrepreneurs who want to be able to move on their vision is in the corporate documents, the operational documents, we work to bifurcate ownership and control. And in essence, what that means is that when you understand what control is, there are the day-to-day operations. There are certain decisions that are not day-to-day. The question is who makes those and how are those made. And in many instances, what we try and do is to stagger the equity ownership among common and preferred, whether it be in units, whether it be in stock, and bifurcate who can vote for whether it be a board of managers for an LLC or board of directors. That's really, in the entity concept, that's where the control lies, and that's something to be sensitive to. Lastly, just to touch on very briefly, one needs to be very conscious of fiduciary duty considerations. Too often we have individuals who have started the company and put most of the money in, new money comes in, and they find that now there are decisions being made that if they have corporate lawyers will tell them you can't vote on that because it benefits personally. So there's concepts of duty of fair dealing, duty of loyalty that need to be fleshed out as part of the process. Next thing to talk about or address is operational considerations. We'll just run through these because, again, each one of these could be significant. But you need to understand what are the recipe for operational needs. What do you need to operate your business? That ties into everything from equipment, personnel, all kinds of physical needs that need to be achieved for you to run your company. Now, one of the things to think about, tying it all back together to this entity kind of concept, is location and physical requirements. We talked about setting up an entity. The question is, where do you set up the entity? If you have all your employees and customers in California, it may not make sense to incorporate in Illinois because one of the founders is in Illinois. There are cost considerations involved, qualifying for doing business. So it's something to bear in mind as we go through this process. If you've raised money and you're brick and mortar, let's say in Illinois, but not in California, you may want to keep it there from the concept that or Wisconsin, where I'm from, the costs of operating the acquisition of land may be much cheaper. So there are so many considerations that go into it. What's the workforce and availability? But it's important to keep in mind the physical requirements, location. One of the things we're just going to touch on briefly is the recognition of the role of contracts in creation of value. I think it's very important to recognize that the people you bring in terms of your management team, the kind of contracts you set up may actually in and of themselves create value for a couple reasons. Number one, they demonstrate the value proposition that you set out to achieve and that you've articulated to your potential investors. So hire really good people. When you get equipment, when you get contracts with the various purchasers that show profit and show value, these can enhance the value of your operation before you've even gone and done them. So the context of contracts, creation of value, is very important. Now, as we will touch on, and this could be about anything, sensitivity to financing issues, you've got to be very, very sensitive because the operational requirements, typically when we do a financing, you have a sources and uses. The operations are the uses, and people that invest are the sources, and they're very sensitive to what you're using and how you're using it. And you want people that are investors that invest in early stage to feel good about what you're doing, your operations, and to support you. If no other reason, then you may need follow-on investing. Two other things to kind of talk about: intellectual property and other value considerations. I can't stress enough in a technology world, and certainly in California with Silicon Beach and Silicon Valley, the importance of intellectual property and technology play. And this is a separate discussion of itself, but suffice to say, I've done deals where there was a transaction worked on, company No Fear. We ended up bifurcating the assets between the IP and the branding and the IP rights, intellectual property rights, and the hard assets. And we were able to maximize the value of that sale. So getting your intellectual property and building that value is incredibly important, and certainly will affect not only your operations, your financing, and many other considerations. Lastly, alternative to operational approaches. This is something that really is not addressed sufficiently in my experience. Companies want to start a business, and one of the things that I ask is, do you really want to be holding inventory, or do you simply want to develop the opportunity and license it? There's so many things that go into it, but I think it's important you recognize that there are alternative operational approaches that you really need to think about as you're developing your business.
All right, then lastly, we're going to talk about exit strategies, but we're going to talk about this, fairly briefly today to just touch on it, because we'll actually spend more time discussing the actual various exit opportunities in our next webinar.
Yeah, I mean, one of the things, again, just to touch on it, the exit strategy, why consider it this inception? It's really a part and parcel of this particular webinar, and that is, if you build a proper foundation, you will maximize the opportunity for a healthy exit. There are financing directives, as we've talked about. VCs may want 3 years and out at 20-30% rate. That could determine your exit, so that's something to bear in mind. Structural considerations, you have long-term leases, the personal guarantees. One of the most important structural considerations, although it's not prevalent today as much today as I saw in past years, but is the concept of, for instance, in IRS Code Section 368, stock for stock. If you do a corporate entity and you exchange your stock for the stock of another corporation, that is not taxed upon the transfer. It's taxed when you do something with that stock. So, for instance, in the old days, when Qualcomm would buy companies and do stock deals, we'd be cheering it because you get Qualcomm stock, which seemed to double every 15 minutes. And when you got the stock for your stock, you got publicly traded, stock that could grow, and you don't recognize tax on that until you do something with that. The other things, a couple of things to bear in mind: the recognition of market and value. It's important to always recognize where your company is going and how you're establishing value and what market you're in. We talked about platform acquisitions. Again, there's so many more things to consider. We just want to whet your appetite a bit, and to let you know, again, there are many possible exit strategies, from family transition to M&A, sale, dissolution, and unfortunately, when things go bad, to bankruptcy and solvency. We'll touch upon that in our third webinar.
Well, so after you've given due consideration to all the 5 foregoing topics and the many that are otherwise certain to pop up in any individual case, it is time to put pen to paper, and the first thing that you then need to do is start drafting documents. And in that sense, we'll touch on the representative documentation. In terms of a corporate entity, it's articles of incorporation, bylaws, and often a shareholder agreement. An LLC, you have a statement of organization, and we always recommend drafting an operating agreement, even though it's technically not required. It's something you want. You certainly do not want to find yourself on the back end looking for the answers. And if you don't have one, then it's governed by state law, and it's not a place you want to go. Your investors are going to be largely interested in the term sheet and financing package. And that's something you'll put together with your professionals. And then, of course, there's myriad other specific documentation. You have employment agreements. You have independent contractor agreements. You need to make decisions about whether you want to, enter into an employment arrangement or a consulting arrangement. You might have a licensing structure. Increasingly, Jeff, and I believe it seems that the licensing is becoming an increased.
Absolutely.
Yeah.
It's a new form of merger and acquisition without an asset sale or stock sale or purchase agreement.
You'll have. You have to consider, the initial leases and loans, and then warrants and option agreements are especially interesting because it's a good way to raise capital, but you don't necessarily have to give up ownership until things have moved along a little bit.
Jason, to follow on in our next slide, we talk about the checklist. We've talked about pre-incorporation planning, preparing draft documents, and again, we could have a separate webinar just on those specifics, some of the nuances of those documents. Suffice to say, they're extremely important. So what happens? You prepare this pen to paper, you prepare documents, then you compare the documents to the business plan that hopefully you've drafted to make sure that it's aligned with your goals and visions. You certainly work with your advisors to make sure that it encompasses the terms and conditions that make sense. Then we recommend you go and meet with constituencies and confirm the documents are accepted. And it makes no sense to draft documents that no one will sign. At the end of the day, this is all consensual, and the most important thing you can do is to meet your needs and find ways to meet the other party's needs so that everyone joins in this process together. Along those lines, what we talk about, confirm balance and harmony, this is an interpretive process and a process that goes back and forth. There may be many rounds. You many times have to balance interests, but the process nonetheless is a confirmation that the documents that you've established that build out your vision work within both the constituencies and are consistent with your vision. Lastly, you want to be very sensitive to time because, as the expression generally is in transactional work, time is not your ally. Let's also conclude the recipe with some additional ingredients. And let me run through these kind of quickly. The first, we refer to the importance of being earnest. I can't stress enough, you've got to do your homework. You've got to know as much or more about your business. You don't necessarily have to know all the nuances of corporate law, securities law, tax law, labor law, accounting terms. Those are certainly, hopefully, will be addressed by your professionals and experts. But I can't stress for you enough the importance of really doing your homework. It's reflected in the work that you put out. We see it, and it's apparent. It may not be apparent to some, but we certainly see it. Second thing, which I talked about earlier, is listen and learn. It's so important that you constantly be testing your assumptions and challenging yourself. And don't be afraid to ask questions, whether it be of people that are experts in a specific area, people that may be generalists, people that aren't in your business. It's amazing what you can learn when you listen. And so, too, it's amazing what you can't learn when you speak. So it's important that you listen and learn. The third point we want to address is address the facts. too often facts come into play that aren't what you want them to be. They may be roadblocks. They may be dead ends. Well, regardless of what they are, you got to address them. And I recommend very strongly that you look at the facts and you have a process in place by which you move your business to address hard facts that may, if you don't address them, may result in problems. The next point is an intellectual versus emotional component. It's very, very hard to be intellectual about a business you start because it's your business. One of the things that happens when money comes in from alternative sources is you need to detach the emotionality aspect and make intellectual decisions. And so typically, and it's tied to the fifth point we raised, use of professionals. Use of professionals, use of third parties is very, very helpful in transitioning from emotional to intellectual decisions. Having said that, I will tell you that I have seen investments in companies come down to whether the person was passionate. You need to have that passion. You need to either have an incredible idea or opportunity, be a success waiting for a place to occur, have a great track record. That certainly works, but in many, many instances, it's that emotional component. It's that the concept of the word sweat equity that's built into a business, that investors and people that do this see through the letters and the pages of documents we look at, and it does make a difference. And so not to devoid your approach with no emotions, but to balance intellectual and emotional considerations.
And that's why we're here. Thank you for joining us. If you have any questions or comments, please do not hesitate to reach out and let us know. Thank you.
Thank you very much.